Hi everyone. Another amazing 2 weeks have passed. Very interesting weeks with a lot of events and a lot of volatility to both sides, up and down. Of course, I have a feeling that we will talk more about the downside today, but we'll see. First of all, Rafael is sick today, so we all wish him to get well soon. So today he will not be with us, but we have Ted and Matt, and I'm sure we have a lot to talk about. And first, before we start, I want to remind everyone that my fractal range is a risk management platform to help investors, both retail and institutional, to manage their risk and manage their portfolios. And for those interested to join, we always have a continuous demo account, free account, which never expires. And also we have a trial for you to try out our services. So yeah, I'm sure we have a lot to talk about. And Ted, it's been a while, and a lot of things have happened in the macro space. So I'm sure we are all very interested to hear what you have to say. So first, what's new in the macro space, and what you see in the market?
Yeah, so I've kept the same background screen that I had back on February 27th when this volatility started. It certainly is stormy weather here. We have snow in Maine, if that tells you anything about what I'm dealing with. So let me start my slideshow here, and I'm going to come back to this theme that volatility exists to take money from the weak and give it to the strong. And I will tell you right up front, I am not strong hands. So I'll touch on macro regime briefly because it almost doesn't matter at this point. Policy, we'll talk about what the policy is, and then we'll spend most of the time on market signals and positioning. So my macro service pivoted on April Fool's Day to deflation. Prior to that, it was indicated as an inflationary macro regime. So the inflation number has come down. Interesting, the day after we met, we met on the 27th, last I was on the show, February. At that time, we were showing GDP now at 2.3%. Since that time, on the 28th, it's printed minus 1.5% to a low of minus 3.7%. Yesterday or last Thursday was at minus 2.8% GDP Q1 estimates based on the GDP now. A lot of people have dismissed this. It's created a lot of cognitive dissonance, in my view. I don't think it's way off. There's definitely a slowing of growth. Let us say that at any rate. From an inflationary perspective, we have CPI coming out on Thursday. February CPI was a surprise to the downside at plus 2.9%. Consensus for March is plus 2.6% headline. On the core basis, February was also a little bit down, 3.1%, down from 3.3%. And then March consensus is plus 3%, which also represents a downward slope in CPI. The Cleveland Fed has us at 2.49 to 2.9%. So basically in line with consensus on core, slightly below on headline. For what it's worth, Trueflation has us at 1.46%. I don't really care what it has to say. I care what this has to say. This tells me that oil's been down. I put this together this morning. It's down 34% since the October 23 high. It is down 15% in 3 days. And I think if we add in today, we're down another 3%. So 18%. Don't think we have a lot to be worried about as far as inflation is concerned. We can dismiss this if we want, but I think it's real and it matters. From a policy point of view, El Presidente came out on April 2nd. Interesting, the market was up into that close that day. He came out after the print. April 2nd is Liberation Day. Great. So Liberation Day meant liberation from your 401k day, apparently, because it kicked off a massive selling situation. From a policy point of view, Powell was out on 4-4 on this Friday. Well, I took a 4-hour bike ride. Thank God I wasn't sitting in front of my screen all day. But basically, what he said is, well, tariffs are highly likely to generate at least a temporary rise in inflation. it is possible the effects could be more persistent. Avoiding that outcome would depend on keeping longer-term inflation expectations well anchored on the size of the effects and on how long it takes for them to pass through fully to prices. In other words, I'm keeping it tight. And, the 2-year has been telling him he is way behind the curve. 2-year, what printed at as low as 3.5. I think it bounced. I could close around 3.7 today. Nevertheless, he's off by 70 basis points in terms of where Fed funds should be, at least tracking the 2-year. So he's keeping it tight. He's keeping the short end of the curve inverted. The 3-month 10-year is inverted again, while we've had steepening in the 2-10s, which is more market-based at this point. So this was printed this morning. I'm sure this has changed, but you can see that investors are pricing in. We're still not going to get a cut at the May 7th meeting. Let's see. Be willing to, if this market continues to sell as it does, we may see this shift even further, and we may get a cut. Certainly, they're calling for a cut by the June meeting, and further cuts heading out further into the year. 5 cuts priced in through, I think, 2 years now. From a market signal point of view, we've got the vol. I printed this chart this morning, and thought that vol event might be behind us. We went on, on last Thursday, we went vol 30. Then on Friday, we went vol 45. Then we hit vol 60 on the VIX before it reversed. I think today we closed in the upper 50s, maybe low 50s. Nevertheless, back into the 50s. So we remain here. We saw the VIX term structure. I thought it was a max inversion on 4.7. This is kind of a warning sign if you've ever seen one. But basically that means that front month futures VIX trading at pricing 37 out to November down at 24.7. This backwardated structure tells you that there is high risk in the equity market space right now. I thought that it was coming down. This was as of 11 a.m. this morning. It had actually, that front month had come up to 29.7 from that earlier high of 37 and priced down as low as 22. But today at 3:30, I looked at this again. We're back to 38.4 on the front end. So we remain deeply backwardated. This remains a problem for markets. And then yesterday we had we had bond vol continue to spike. I'm not sure where we closed today in the MOVE index, but we were at 137.30. This is creating problems for those that are seeking shelter in bonds at this point in time. I just noticed earlier today that Alpha Exchange put out this very interesting chart. What this shows is SPX high-low range during some of the most tumultuous market conditions. You can see at the top of the page on October 10th, 2008, we had a high-low range in the SPX of 10.7%. So basically from the high to the low, we moved 10.7%. Yesterday, we had an 8.1% move. And what happened to TLT, which often serves as a hedge? On average, it is up 40 basis points on a day like that. We were down 3.0%. So basically, correlations are moving to zero. There's really very few places to hide at this point in time. If you're lucky enough to be short, if you're lucky enough to own put options, or smart enough to own put options into this event, you're doing great. Otherwise, it's very challenging, very difficult to risk manage given the speed of this. Wanted to just share where I was when we last spoke in terms of positioning. I was short dollar. I was long gold, GDX, silver. I have a portfolio construction process, and it's volatility based. I'll explain it briefly before I get into the charts. But I was short US dollar, long gold, GDX, silver, and basically metals. I was long bonds across an ETF spectrum, long CTA, which is a commodity trading advisors fund, IVOL and TUA. IVOL is a steepener, and TUA is a levered 2-year play. I was long also international equities, EZU, EFA, and EEM were all doing reasonably well. I was out of SPY and Qs and PDBC, which is a commodity fund that's been messing with me since I've existed. Where I am today, I remain short dollar, long gold. However, my stops have been hit in gold and in GDX. So I'll explain my exit strategy, but I'm moving out of both of those positions at this point in time. I remain long bond, BND, IEF, and TIP, although those are starting to deteriorate as well. What's working is long IVOL, TUA, pretty much nothing else. Quickly, just to provide some context in terms of the dynamic positioning portfolio rules, it's large. It's mostly a trend following system. It's long bonds, equity. It's a long only portfolio, long bonds, equities, commodities, alternatives, and FX. I have a mean reversion overlay because one of the problems with trend following is you never catch lows, and so I have a mean reversion overlay that I use based on Williams percent R, which gets me long small position in terms of reversals. I also have trailing stops in place that are at 2.5 times average true range. And when my stops are hit, I don't take it all off at once. I don't place the orders live in my trading platform. They're outside the trading platform. I get notifications. When my stops are hit, I'll take 25% off a day. That keeps me long sometimes because oftentimes my positions will be very close to where you would really want to buy, but my stops, because they're trailing stops, are at a higher level. And I also trade around core positions. So I buy dips and sell rips so long as we're remain in the regime and not stopped out. So let us take a look at some of the charts. So as I mentioned, is this updated? Yeah, as I mentioned, I am short dollar. I had been long way back here. We talked about that. I have been short since this range here, since we talked on the 28th. The way that I'm expressing my short dollar position is via FXY, which is the long yen. And this has been a good trade for me. Generally, I got long back in middle of January, added to position on the 11th of February, got a stop at this point. So I took a quarter of my position off. It turned the next day. You can see I really should have been buying here, but where my stop was positioned, had to get out. Those stops are based on average true range, as I mentioned. I added to the position here, which was very close to my stop back on April 18th. I hit two stops. I have a half a position open at this point in time, and it continues to work. FXF, which is the Swissy, got long this very recently, back on the 20th of March, got to a full position here by the 25th. Got a real nice spike here on the 3rd of April. I thought, geez, I'm super smart here. I really hit that well. So I took some off on the 3rd. Took about, I don't know, about a 10% position off. So that's continuing to run. I did get a sell the next day, but then here we are. We're continuing to move higher. Swissy seems to be a safe haven, and so there is some money to be made here. Gold has been a position that I got long back in early January. Sold a little bit on the way up. Bought, stop. I took some off right here. So I basically was at a 300 basis point position, which was down from about 500 basis points. And on yesterday, my stop was hit. So that's a position that unless this thing goes higher, I am working my way out of the balance of my gold position. Not dissimilar with GDX. GDX, here's a situation. This is on the 3rd, so it held up really well after the Liberation Day announcement. But then Powell was out on the 4th, and the thing basically, I'm on a bike ride, and this is setting off a stop. So took some more off today. Thought we might be getting a nice reversal in, but doesn't look like that's the case at this point in time. DVB got out of this thing, thank God, at the right time, but this was looking like a pretty good position. And then basically last week happened and I got out, and I hate to sell at the low end, a low end of a range like that, but it is what it is. Rules are rules. And so I didn't get punished because it dropped another, I don't know, 200 points, two full points. So a massive drubbing in commodities. Bonds, unfortunately, aren't behaving much better. I am darn close to a stop right here in my BND. I had an initial position, just been riding it, got a nice pullback here on the 28th, added to it, sold some on the 3rd when we got a little bit of a rip. And now, of course, bonds aren't doing well for us either. Similar situation with BNDX, although I've been out of that position when it sold off back in early March. So European bonds, as you might remember, really started to sell off when Trump was putting the boots to Europe on military policy. So that's not been a good position, and the volatility obviously has increased considerably. Liquid LQD got out here, thank God. Let's see, IEF. So this is a position that has worked okay. I got long in the middle of January. 10th of March, I took a little bit off on a nice run, added to the position here on the, what was that, 27th, sold a little bit on the 3rd. Now we pull back. And so this is dangerously close to a stop at this point. Tip, similar situation. My stop was hit. So I'm starting to work my way out of the tip position. EMB, disaster. This is emerging market bonds. Got stop out, and then, wow, just crazy waterfall. I don't know how you risk manage this if you don't have signals like yours, Vi, that give you the ability to start getting out when you need to get out. CTA, this has been great. Really been a nice fund, been something that you can trade around. And then, took some off here on the 1st of April, and then it is just sold hard, stop, hit, getting out of that position. What is working? Eyeball, short-term bonds. When we talked last time, I was saying, geez, this thing's just done nothing. I've been building position, got to a full position. I think I said to Raphael in that meeting, I might cut the position, and just the next day, just started to move. Added to the position back here on the 2nd of April on a little pullback, sold some on the 3rd, and today it ripped again higher. So eyeball, interest rate volatility continuing to work. This is a play on a steepener. I believe we are going to get a massive steepening once the Fed wakes up and smells the coffee. They have not done so yet because the administration is dead set on reordering economics here, which means, in my view, a recession. TUA, I think this is my last one. TUA, levered 2-year, working great. Continues to added some to my positions here in mid-March, sold some on the 3rd, sold off, and was up pretty smartly today, up 45 basis points on a 2-year note. So that's not a bad way to go. Oh, just want to get this. This is Europe. And this, I was out of SPX and out of Qs, and Europe was working great for me. Got long, first position on the 17th of January, added the position early February, sold some, bought some, sold, and then my stops were hit. I had already had a reduced position because I had a signal on my Williams percent hour weekly chart that said get out, or at least reduce exposure. So I had reduced exposure by 25% coming into that week, and then stops were hit, and we got out in time. I'll skip over the next because it's very similar, which is EFA, EEM, disaster. And then this one, I got smoked. So they're not all winners, that's for sure. So this is PDBC, commodities. I mean, this thing, I ended up getting out in late February. I got a bullish reversal here. I added, built a full position, was going great right up until April 2nd. Boom, stop hit. Friday, still working my way out of that position. I sold some on Monday just because I had to. So it's not been a smooth ride by any stretch of the imagination here. I don't personally know how most people are managing this thing. And then I'll stop here. We talked about this just a few minutes before we started the show. This is the SPX weekly chart. This is a weekly chart, as I said. This takes us back to the October 10th lows. We are looking at a high of roughly 6,100. It was a double top here in December and then into February. And we are right at Monday's low was right at a 50% retracement on the Fibonacci. I will stop talking at this point and just let you know, I don't know if we stop here or not. We certainly need to have the vol come out of this. Policy is toxic, and a Fed that's tight. This is not a market to be long in.
Thanks, Ted. Great insights. So, Matt, what charts are telling you, and what are your views on the market?
Yeah, thanks, guys, and hello, everyone. For me, my positioning for months now has been cash, and that's in trading accounts as well as my 401ks. All the money I manage is in cash and T-bills. I just simply rotate. I have a short-term ladder that I do, which is 2 years in duration max, because I'm not taking any chances on the end of the curve, because nobody knows where that's going to go. I think it's interesting, Ted, you talked about deflation, because I agree that at least the warning signs are there with, I was just looking at crude oil. The three bigs for me are crude oil, copper, and lumber prices, and they've all tanked in the last week. But at the same time, if I can share my screen, Vi. Let me see if I can find what I was looking at here. Signals. Is that it? Let's see. Is it sharing?
No, but all participants can share screen. I think you have a permission.
Yeah,
to
it's in the
do it.
right underneath in the middle of your screen at the bottom.
Oh, I see. Okay,
Sure.
here we go.
Yes, yes.
Here we go. So I was looking, in addition to looking at those three commodities that are pretty huge, economically speaking. I was also looking at, yeah, it's blocking my screen here. Sharing this now. All right, can you see my charts? Can you see this
Chart
now?
of ICE.
Bank
ICE,
of America Option Volatility Estimate Index.
yes.
Okay.
Move.
What is it showing for me? I'm not seeing this. Let me try this again. I'm trying to
Showing
share
your move index. It was showing you move.
the move index. Okay, I apologize. So yeah, that's a huge move. Let me. I'm sorry. I'm having technical difficulties because I'm old. Okay, is that back on? Move index.
Yeah, yes.
Okay.
Yes.
So that to me is shocking. Now, what I've heard, or at least what I've heard today, for the reason for that move yesterday in TLT, is China was firing shots across the bow at Trump, by selling a good chunk of treasuries, which would make perfect sense to me because, in a trade war, it's not just one-sided, and China certainly has some power economically in regards to their U.S. Treasury holdings. I think they are the largest foreign holder. You could probably have to confirm that, but so that was the main reason for the move index skyrocketing, as well as treasuries on the long end coming down. The other thing I was looking at were the two things that indicate, at least ETFs that indicate inflation versus deflation, is you have the BNDD, which is actually not looking good, and in fact is not indicating deflation, and PFIX, which is indicating inflation. So you have these mixed signals that are very confusing because you have these two ETFs that are doing the exact opposite of what you would expect if you're expecting deflation based on commodities prices moving forward. So for me, again, it's like there are no straight signals in terms of inflation versus deflation, and I think it's just we've just got to let this play out over the next few months. Um, the where I said I was again position wise, I actually do have one long position in my 401k, and that's I'm short junk bonds through SJB, which is an inverse ETF for the junk bond index and ETF. And if you look at SJB, it's starting to pick up steam and starting to look like there's starting to be cracks developing in that space, and of course the junk will be affected far more if we come upon a recession, which I do think is happening. Um, Quick macro take on that is that we're in a controlled demolition, and I think it was outlined fairly early in the Trump administration that they intended, and this is for election reasons for the most part, is they're going to come in now and knock things down, knock things out, in order for the recovery to begin before the 2026 midterm elections. And so from a political perspective, it makes perfect sense to get this out of the way now because you can kick and scream all you want, but there's not much you can do beyond complain and wait until the elections to make your choice. If you're upset with the current administration. And so if they are able to turn this thing back around, and then it's mission accomplished for what they're doing. I don't think many people see it that way, but that's kind of the way I'm looking at it in terms of the macro picture. Um, I'm going to go back into kind of my analysis that I do. Most of my trading now is just done through credit spreads and on options. And I also am day trading ES micros. I minis, actually, I'm sorry to say that, micro. And so I'm keeping myself awake less at night because my positioning is cut at the end of each day for the most part, with the exception of a runner trade that I will allow to continue overnight. I usually don't do those through the weekend. I'll reset on a Friday and come back on Sunday night. So the analysis that I do is shows I like to look at VWAP, the volume weighted average price, and I like to anchor it at the beginning of the year for almost all of my what I look at. And I follow 35 sectors, and right now, um, 33 sectors are below their yearly anchored VWAP. Only two are above. And Ted, I'll let you guess which two might be above. What sector do you think those might be?
The question is again, sorry.
The only two sectors that are trading above their yearly anchored VWAPs.
Wow. Uh, it would have
Think of
been
what,
XLE. It would have been XLE prior to last week.
yeah, but think of
But that got crushed.
what were you long in?
Oh,
I think everybody was. I know Raphael was too, and he cut his position recently.
I don't
It's
know.
the shiny metal.
Oh, yes.
So
It
it's
was.
it's the and it's the miners. So it's GDX
Yeah.
and the junior miners are the only
Yeah.
two sectors out of 35 that I follow. So things are just being obliterated out there. Of all S&P 500 stocks, 441 of the S&P 500 stocks are below their yearly anchored VWAP. So this is truly a bloodbath, and we are indeed in a bear market. And so my strategy for that for my option spreads is going to be selling any rip after a confirmation that I have in my system. And I don't want to be long on any level with the exception of intraday S&Ps level to level, because that's one way you can actually trade this on both sides. So beyond that, I just had a couple of things. Ted, you already showed this. Can you see my screen here with the VIX term structure?
Yes. Yep.
And so same thing as you showed, Ted. I always calculate today versus yesterday, and you can see today's was lower than yesterday, so that's a good sign, I guess, that things might be flattening out. But tomorrow could bring a whole new thing. The other thing I do is I do moving average analysis, as well as I have my own 5 trends that are extra short duration, short-term duration, medium-term duration, long-term, and extra long. And you can see that this is of the S&P 500. The red bars are bearish. So for extra short term, you're seeing just this massive bearish bars all the way through, and even the extra long term trends are massively bearish compared to anything I've seen in probably 3 years. And on the right side here, I show the change in the exponential moving averages from a 5-day, 8-day, 13, 21, 34, all fancy numbers that you might recognize. The moving averages are all declining. And so these are not signs that the bottom is in. I mean, I know these are lagging indicators, but at the same time, before you dip your toes in the water, you're going to want to see, at least on the short end of these charts that I'm showing you, the extra short term trends, as well as the 5 and 8-day exponential moving averages. You want to see those coming back and have the green above the red before you come anywhere near. Otherwise, you're taking severe risks. I mean, if you're young and you're willing to do it, then by all means go for it. I have the same analysis that I do with the sectors again. In addition to VWAP analysis, this is all moving average based, and so I have my 5 different duration trends that are all showing extreme bearishness. And then my exponential moving averages, again, you don't even see any green for everything up to the 89-day exponential moving average. So again, a lot of people the contrarians out there would say, oh, well, this is perfect. This is the ultimate capitulation. This is the ultimate fear indicator. But based on what I see with VIX and what I'm seeing in the interest rate space, there's just so much uncertainty out there that there's no chance that I would even dip my toes in anything long. I will continue to just rotate through Treasury bills until I see some sign of clarity in terms of things actually building a base, which they are not doing right now. As we saw today, all the buy the dip folks came back in today and saw a 4% gain in ES futures, or the S&P, beginning of the day, and it was completely crushed by the end of the day. So the volatility is one reason that I stay completely out of the market. I told Vi and Ted earlier that my day today consisted of going to our local hardware store, buying some seeds as well as pots, and I planted my garden and did not even look at my screens. So for the most part, that's where I come from. I'm leaning very bearish, and until I see even the shorter term indicators that I follow come to life, then it's not going to change my mind. So I will sell every rip. And there will be some too. You're guaranteed the standard formation intraday, which is an elevator down move followed by a break back up and a short squeeze. And I think we're gonna have a lot of those coming up in the next probably the next month plus, until the tariff issue is settled. And who knows if that's even going to happen anytime soon. So that's my bit.
Thanks. Yeah, definitely. I agree. We will have plenty of rips, but actually we already had one and it ended. So we'll see how it goes. Ted, the question, I don't know if you touched, I mean, you touched on that, but I want your thoughts on actual signs of capitulation. For example, I think that capitulation is still not there, and we don't see any signs of that. But my question was not that. From these recent moves in gold and bonds, what are you taking from that? I understand that the people are selling winners to take money out or so, but what would you be looking at from these macro sectors perspectives, gold and bonds, for you to think, okay, maybe the capitulation is already in play?
I mean, I heard the China theory. It could well be, but my view is that that was largely a tap on the shoulder, margin call time. Got to sell what you can't sell. Got to sell liquid. Gold's been obviously doing great. That'll be used as collateral for anybody will take that as collateral at this point. The other thing that I heard was that some people were saying, "Okay, I've been well protected. I've had gold. I've had TLT. I've done okay." I see a 50 handle on the VIX. That's pretty historic as volatility goes. We see sentiment across the board from every indicator that you would look at, pretty nasty negative. Maybe it's time to sell some of my winners and get long SPX, some of the indices, just to stick my toe in the water. So those are my two primary theories about what's happening. But I mean, there's not really a macro reason to be selling your gold. In fact, if you believe the deflation argument, you should be getting good response in your duration. I mean, Matt pointed out BNDD, which is a long duration asset. It looks ugly. I looked at PFIX, which is more of a volatility instrument. It's actually much better way to play this move in the move index, because it definitely reflects the increase in bond vol. So it's I don't know. It's not the bonds aren't behaving like they should. Either they're being liquidated by foreigners, or people are just selling what they can. There could be some rebalancing underway for that matter, but I just, it's hard for me to know. I don't know I'm not in a big bank, so I don't know, but those are my theories.
Yeah, thanks. Great thoughts, and totally agree. And Matt, regarding all your trend signals, and you said that it's definitely, we don't see signs of any bottom, which I completely agree. But my question would be, what you need to see, these moving averages and other indicators you showed and you talk about, to think, okay, now maybe this low, whatever that low will be, this low may be the low. What would you need to see?
Yeah, I need to see the slope changing
Oh, yeah.
on all of these, and that's all. And that's a simple way that I look at things is if the slope is down, and you have moving averages stacked on top of each other, where you have the shorter terms below the longer terms, and they're stacked in order. That's a terrible sign until they start to, number one, unstack and cross each other higher. Because all the moving average does is take the noise out of your daily moves. And so I would want to see the number one, the slopes of these moving higher, and I calculate that too. And until I see that, there's a 0% chance I would allocate any capital to anything. And the only thing I will say too that I did not get stopped out of gold. I do have gold. And I manage a couple of accounts that have it in there, and I'm about to purchase more, but I'm going to have a very tight leash on that because I think, Ted, I think you are right about that. I think the conspiracy theory is that China is selling bonds. But I do think that people are just having to liquidate and margin calls are being made. And where do you go? Well, you go to your lowest duration, something that's going to be easy to cash out on. So you are getting rid of your treasuries and TLT, et cetera. I'm surprised we didn't see a bigger move in SHY, even though it doesn't move much, SHY, but it seems to be a good place that stores value in this day and age. It's just barely trickling up and barely had a down move. So yeah, so I think also it would be on the economic side. I would want to see stabilization in bonds. and especially on the long end. And right now, it's all over the map. I mean, there's no indication. You can't even perform technical analysis on the 10-year Treasury. It's impossible right now. So it's just complete chop. And so until the volatility comes down, also, I mean, that's the obvious one. Of course, the ones who win are the ones who buy VIX or sell VIX at 80. But does that mean volatility is over? No, we could be in a range of 30 to 50 for the next few months. Who knows?
Yeah, and if
So
you're doing that, you got to do it with spreads, right? I mean, that's the only way to manage it with the vol so high. I mean,
absolutely.
Buys have been a strong believer in spreads. When I trade options, I only trade spreads. I don't
Yeah.
have any open positions.
I'm the
It's just no
same way. I have the option under my system to trade naked calls and puts, but I refuse to because the spreads are just a much more safe way of protecting your assets in the end. And so, yeah, with the high volatility, spreads are an amazing way, but you have to have your timing right on those as well, unless you're doing Vai's specialty, which is your iron condor style things. But with an iron condor Vi, I'm not as familiar as you are with those. You still need you want price movement to somewhat stabilize over the duration of your trade, right?
Yes, very good point. And now is not the time for iron condors.
Right.
And it's one of, when it comes to options, one of like 3, 4, maybe my most used strategies. But first of all, iron condors work well in a volatility environment, which is higher than, let's say, median or whatever. So, I mean, of course, you don't want to do them when VIX is maybe 13 because you will not be able to get wide wings and you will not collect a lot of premium. And when a lot of premium, usually I'm talking about 1/3 of the width of a spread or something, or you will have to do it very narrow. So no one should do that. Yeah, so the perfect environment from VIX 16, 17-ish to VIX 20 something, yeah, of course. Above VIX, I will say 25 just to have to say some clear number, but I would say it's a bit lower than that. But above VIX 25, not, and also not on the low or the high of the move. So just simply, if the market is going down, you want to just a little bit of a retracement. Then you can initiate that iron condor. Or if the market is ripping, you also want just a little bit of a dip, and then in there. So yeah, so that's how I do iron condors, and yeah, definitely now you will think that you can collect a lot, and it's true, but believe me, there is a reason why you can collect a lot, and that reason is that most likely your short strikes will be tested for sure. At least tested, and most likely will not only be tested, but will close there. So
yeah, and
so, yeah.
with the spreads too, I take it one more step in terms of safety, and I will only trade an in the money spread, both sides, because there's a less chance of premium loss when you do that, and it adds another step of safety.
I always do that with debit spreads, always.
Yeah.
So that's just another thing. When I buy debit spreads, because it makes sense for me to do so based on analysis, I buy in the money or at least at the money. Yes.
Yeah.
Never lotto tickets, but with credit spreads, no. For me, the point of a credit spread is that
yeah, and I may have made a mistake. I don't trade credit spreads. I'm strictly debit.
Oh yeah, yeah. Then it totally makes sense because, for example, with option pricing, and in this volatility environment, at the money credit spread or at the money debit spread, well, basically they would pay the same. But the point of credit spreads, for those who are using credit spreads, and I use them quite a lot, the point of the credit spread in the correct and suitable volatility environment is that you start out of the money and you have cushion. That's the entire point. Yeah. If I just think that market will go up, let's say rip or crash, but from here and I have a clear target, then yes, it's a debit spread. I would buy debit spread because when I sell credit spread, my view is not extremely bullish or extremely bearish. My view is just that market will not go there. That's it. So, I don't know. I hope it answered the question. But yeah, iron condors, be careful with them. It's an amazing strategy, but if you do it at VIX 50, come on, good luck.
Just one quick question with a backwardated curve like this. Would you be looking at using time spreads or some sort of calendar spread to maybe monetize some if you wanted to?
I rather now not anymore because how I view it, calendars. Well, simply put, calendars for me is a pretty significant view on long volatility. So I want volatility to go up for that. Not too crazy, but for me, it's a bet on long volatility. What I would do, and I tried a couple with zero DTEs, and it made sense to me, is long butterflies. But with butterflies, it's a short term. I mean, you will not do a butterfly which expires in 3 months. Those who understand option structures, you know that it would not make much sense. But butterflies are way better because with calendars, not now. No. Calendar, I use calendars and diagonals, mostly diagonals. I rarely use calendars, but it's the same thing, just strikes are different, same idea. But I do it to trade catalysts. Trade catalysts, it means I think that stock, by the way, now we can't say XYZ because apparently it's a ticker, so whatever. But some random stock will beat earnings like crazy, and I want to structure a bet for cheaper with a bigger reward, but yeah, still have a quote unquote, which is of course not a thing, but that's why quote unquote, but unlimited upside, but cheaper. Yeah, I would sell an option which expires before earnings and buy some that expire after, and I would definitely do that. But it's not based on the structure of volatility for sure, no. And market makers know their stuff very well, so way better than. Yeah, so time for my part, I believe. Yeah, so I will start from regular stuff. First, I want to start with correlations. I see that there is a question on YouTube that a person wants me to talk about what would be a potential turnaround based on my fractal ranges, Hurst, momentum, and so on. My answer is very short and simple: bullish trend. And hint, it's not coming soon. So yeah, that's it. If you are looking to bottom fish or catch bottoms or something, wait for bullish trend. Now for those who are trading on both sides, now you short the break of every level with correct risk management. And today I will touch on that a lot because I feel responsibility, because if I said that you should short every break, I think I need to tell how to short without getting killed. But anyway, correlations. And first, it's a 10-day correlation. Yes, it is a 10-day correlation, and we see that almost everything in these sectors is quite highly correlated. Of course, I'm now only talking about equities related things. Apart from XLPs, things like XLP, things like XLU, which is a normal thing. Even things like XLY have quite a big correlation to 0.9, so that's worth mentioning. But when we look at our average sector correlations to the SPY, which is a freely available tool, for me it's very, very useful and important tool. We are not too crazy. We are high. But we will be higher if we get the continuation of which this downtrend, which I think we will do. And I would need to see these numbers in different time periods above 0.92, 0.95. When I say, okay, now this situation could mean that maybe we'll get a pause, at least some pause, but it's definitely not now. And even though correlations are behaving as expected, but 0.85 is not something you should be thinking, oh, that's crazy. No, not yet. And if we switch a correlation period to, let's say, 21 trading days, yeah, okay, you will see that not a lot have changed. Not a lot have changed. And when I analyze correlations every single day and I see that, it's actually something worth talking about, because now short-term correlations, like Matt said with his trend signals, you can interpret it this way. I mean, there are no changes in these correlations. Correlations are going up. Of course, correlations can go higher than 1, but correlations are going up. Market is in the mood of selling everything that we have. And I will touch on gold separately, because I also want to talk about buying some gold at specific levels and why I'm planning to do that. And yeah, but even with gold, that's what you want to see. Well, not that's what you want to see, but that's what you should see and understand what you're looking at. Gold is quite positively correlated to equities for gold. That's what I want to mention, because knowing the average gold correlation to equities, when you see 0.4, 0.3 on a short-term basis and mid-term basis, you should understand why it's happening and what. So regarding correlations, watch average correlations to 0.95, 0.92, 0.95 there, and check the outliers. So especially XLP and XLU, I will touch on them separately, but this is the signal. This is the signal of a regime when it comes to equities. For example, Matt is digging a lot deeper. I believe Matt said he's looking like 35 or something. I look the main ones, 11. So spiders. For me, it's enough, and from those I look XLP and XLU. They're very closely. Usually it's XLU, but I don't ignore XLP obviously either. Okay, so ranges. Well, I don't want people to make mistake because when it comes to longer term ranges, whatever you are looking at is at the low end of the range, and you will see caps across the board. You will see caps across the board. One thing I need to tell you is don't buy bearish trends. And when you know that, you will be okay. I'm sure you will be okay. And also, there is no such thing as missing the move. Because, of course, and I talk with people in DMs and I see comments and other threads that people are talking on X and so on. And there is this, that, oh, but if I buy something, it's not necessarily NFR related, but people say, if I buy something only when it's above 50 moving average, or if I buy something only when it does this or higher low or whatever, I miss a lot of the move. Well, no, you will not miss a lot of the move. If it's a fake move, you will save money, and if it's not a fake money, you will enjoy a long ride in the next cycle. there's no such thing as missing the move when you are following the process, because first of all, our process here and what we do with my fragment range is made for active portfolio management, not for day trading. There's no such thing as missing the move. You know what will be way worse? If you buy something bearish trend just because there is this cap and prices below the cap, and you will get a bigger move down, another 4 sigma, 5 sigma move or whatever, so 4,400, 440 or something. That will be way worse. It will be way worse. So yeah, so that was my answer to what I'm looking at. I'm looking at everything. I can tell you that Hurst exponents are pretty high, especially now on stocks like Apple and so on. You will see that Hurst exponent is 0.76. You will also see similar numbers on some other stocks. And what it means, I would use this Hurst exponent for trend continuation down, not trend continuation up now, because trends are strong, and you can see that from everything, from momentum score, from how far away we are from the MFR trend, how high are some of the Hurst exponents. They're all relatively high, but some are insanely high. That's what I wanted to mention. So don't ignore that. Don't ignore that, and that's what I wanted to talk about MFR stuff. MFR stuff got people out in February. In the case of if, of course, you got out when you saw it. But yeah, that's what I wanted to touch on when it comes to ranges, trends, and momentum. Now, trend, bearish trend. That's all you need to know. Bearish trend, you don't buy. Now, I will go to gold. And now, I always analyze futures whenever possible. I think that everyone should be looking at futures for assets where futures are available. So when it comes to not single stocks, everyone should be looking at futures, even if you are not trading futures. And obviously, most of you are not trading futures, and you shouldn't. But futures will always front run everything, and futures lead everything. And just have a watch list of futures contracts. So what I will say now and what I will do now, what I will say that I will do if things happen. You don't need to do it in futures. You can do it in GLD. You can do it in miners or anything that has a huge positive correlation to gold or something. But again, what am I with gold? I will start with gold because I know that I will talk a lot about ES a bit later. So just to move quickly with gold, I'm eyeing a very specific level. That level is 2916.8. You can mark that level on a chart. It's a 2816.8, and I will. Here we have no secrets. Here we have no secrets. So I will show you exactly why. And I talked about these things a lot of times, but know how futures markets work, what final settlements are, and yeah, by the way, not all gold months are front months. So when rollover happens, you will see how we roll. Usually it's every other one. What is 16.8? It's a February contract final settlement price. When it comes to these final settlement prices, market always has memory, and I want to buy gold. I have eyeing gold for quite some time. Of course, I had no reasons to buy that based on my process on when gold was trading the levels it was trading at. But now when we see this let's call it dip, which some of it was selling to cover margins and to take money out and so on, because people are selling winners first, which is another topic of insanity, but that's what's happening. And so I'm talking about those people without margin calls. When we have portfolios, for some reason, they sell winners first. Other people, of course, they are forced to sell. But anyway, this level, 29.16.8. When gold futures, so front month gold futures, if that happens, front month gold futures trade at 21.16, I will buy some gold. And if something changes, I will tweet, but I doubt. I doubt. What I mean by that, that if we trade that level, I will buy some gold, because I think that it will be a very, very important level to spot, to load on gold. And of course, do it responsibly, not 100% of your capital. But yeah, another level with 28.70, but I doubt that we will reach that quick, and 29.16 is quite likely. Okay, so now I will go to ES. You can easily translate what I'm saying here to things like SPY, for those who are trading SPX options or something. So you can translate what I say very easily to SPX. But again, I always use ES. And yeah, so what is happening here? And why for the last couple of weeks and a bit more, in order to help you navigate all this thing, I was tweeting all these levels every single day, multiple times a day, and you see that majority of those levels, they don't change, because these levels come from either settlements or very, very long-term moves and long-term structures. But what is happening here? First of all, about the Monday slow. Why Monday's low was so significant, and why it's not the low of the year and not the low of the move, and so on. So let's touch on that. Let's clean the chart. Clean chart is the best chart. So we have a daily time frame of settlement prices. Always use settlement prices. Never do two biggest crimes in the futures market. So first, never back adjust. Secondly, always use settlement price. And when you use settlement prices, you will also know that that April 2nd liberation day settlement price is 57.12, not 55.84, like some people say. But it's one thing to note. But okay, so now what we have. Where was the low? You will be able to repeat that same thing for any futures contract, but I want to show you how to navigate this and how to not get killed in all of this environment. So the high of the all-time high was 61.6650. 61.6650. It happened on 19th of February. Now, what was the, let's call it, cycle? We can go to a monthly chart, it will be easier, or at least weekly, it doesn't matter. What can be called as a new cycle for this market, where market was not having huge dips, let's call, and so on. So the cycle you should be looking at is 2022. So, and in 2022, what happened? In 2022, the high was 48.08. The low was 35.02. I already know these numbers, but I want to show you how we arrived. So we can easily say that from 3,502, market went to 61.6650. I don't want to pull out the calculator here for everyone to see, but that's basically this high minus the start of the move. And we already know that the start of the move was 35.02. And it ends up at 2,664 points. if I'm not mistaken. I'm trying to do that in my head, but 2,664. The 50% level, which is very important from all these major moves, is basically, if you take half of that, I think that with Microsoft Paint or Apple Paint or whatever, it would be easier for you to understand. But basically, you take half of that move. And if you subtract half of that move from the recent high of 61.66, you will get 48.34. So I believe I just screwed up by not using some notepad or whatever, but 48.34. And while a lot of the big players who need to allocate capital and need to start allocating capital, and with other when you need to allocate big sizes, it's a long-term process. You can't do it in one day or so. You need to start somewhere, and some people started. I know that, and why it's not below, because this level, which is very important level, it happened during Globex. The market never traded there during regular trading hour. So that's the first thing. That's the first thing, that this is not below. This is not below, and I can. My view is that this bounce that we had for a couple of days, and I will show you very soon why the level where it made this rise is significant, is very important. But the high of today, and which was almost the same as the high of yesterday, was the high of this bounce, at least for now. And for now, what needs to happen is that we need to make a new low, and that new low will be brutal. Will be brutal. Well, what I want to say, everyone, regarding targets now, that if we go to the current low of 48.67, and now why the low is 48.67, not the 48.32, is because if we get rid of the noise, and yes, the low was 48.67. Am I right? Yes, correct. 48.67. So watch that level carefully, because we are going there. And below that level, first we will be eyeing 48.08, which is the high of 2022. Is very important. Very important levels to watch in the ES. And after that, we have 46.94. 46.94 is the settlement price of December 2022, if I'm not mistaken. Yes, Z 2022. Yes, correct? Well, I made something wrong. 2023. Now I understand why. Of course, the problem is me. As always, the problem is me. Yes, daily chart with the settlement. 46.94. 46.94, to be precise, 46.94.25 is the next pivot. The next pivot level. And from that, I will update new targets. I can tell you that the next target is 44.50. With a short stop at 46.40. But now what to do with these targets? Because, I can talk about random, not random, but some levels, some targets, and basically how to navigate that. So for those who need to allocate capital, and I talk with people, and maybe some of you are watching, but for those who need to allocate capital, you can slowly start allocating capital only close to these levels, because especially on a break up from one level to another, you can add on a break of another level. Because if you need to allocate capital, you need to do it in places where you will get liquidity, and you will always get liquidity at these levels. I can assure you that. But for majority of my fractal range or audience and my fractal range users, especially retail users, I will tell you how I do it, but I think that majority of people should not do that. I always talk about opening range on Twitter every single day. An opening range is defined by the CME as the first 30 seconds of regular trading hours. And it's always 30 seconds. I know that a lot of people use whatever opening range they can come up with, but it's not opening range, because this opening range was on CME bulletins, and all the pit traders were using it for decades and decades and decades. It's always 30 seconds. So, I use the breaks from these opening ranges to be long or short, because again, my trading is not predictive, but I need targets and I need places to be aggressive and add to the position. So I know that people were asking, oh, you are talking about these levels. What are you doing with them? What I am doing with them is, if I'm short below the opening range, I will either cover some when we reach the next level to the downside, and on the break then, because usually I just cover and then re-short again, because then on the break below we go to the next level. So that's how I use that. But how I can be useful to people who want to know when to buy some for the long-term holdings, where to start allocating capital in small percentages or so. It makes sense to allocate capital on these levels. And that's the best, because I know that people want to do that. And I feel very bad usually when I talk about those things, because you shouldn't buy anything when prices are falling, and you shouldn't buy anything when prices are bearish trend. But people want to buy stuff, especially things like SPY, QQQ, and so on. And so best thing you can do, if you can't just sit in cash and want to do something, then buy very, very small percentages, like 1% allocation, 0.5% allocation, or whatever you use as a small percentage to buy at this level. So the next level is 46.94. Major level, big level. And for that to happen, we need to break the lows, which I believe we will. So this is the downside. First one is 46.94, and I will keep you all updated. These levels are very important. Big money are always watching those levels, and they will work, and they are not new. It's not something I came up with, but you need to know if you really want to start allocating something. So now to the upside. To the upside, 52.90, actually 52.86 was the high of the day, which was very, very important high. And all below this, like I was tweeting, that below that we go to 51.01, and 51.01 is a settlement price. I showed you that many times during this stream, so I will not repeat it. And below 51.01 we go to the new lows, and that's my game plan. And also I tweeted that. I believe I replied to Raphael's tweet last night with that game plan. And on a break, that's a keyword. On a break of the lows, I will add to shorts for sure. For sure, I will add to shorts there. Now, the last thing I wanted to show you is why this 52.90 level is important, and why I think that market is going down, and that we had already the high of the bounce, and the bounce will not happen. So first, I want to talk about Liberation Day, and that day was great. It liberated a lot of people from their 401k savings and joy of life. So everyone is now liberated. So what happened before? What happened before the event? So where the S&P 500 settled? Where the S&P 500 settled is 57.12. Now again, most likely the best is to use some notepad, but I'll try to explain. 57.12. Where was the regular trading hours low? Regular trading hours low was 48.67. I already talked about that. It was 48. Now it says 48.32, but I don't use that, and you shouldn't use that. It's not the low, and market hates in general when it comes to futures, when low was made in Globex. So it's not the low. The low was 48.67 because it was the regular trading hour. So now, if you take that 57.12 and you subtract 48.67, you will get 133 plus 712 is basic. Let's call it 845 points. Let's call it. And when you add half of that, you get exactly 52.86. You can do that for yourself, and that's where the market stopped on Monday, and that's where the market extended a little bit today and then reversed. So just keep that in mind. I see that this rant is a bit different, and it's already taking long. So I want to wrap it up very quickly. But basically, what I wanted to say for everyone who is risk managing now and hopefully sitting in cash or at least not in equities, don't chase, don't buy, and if you have to, if you have to, know where you want to allocate the capital. But for any retail trader, any retail investor who is actively managing their portfolios, wait for bullish trends. That was my rant, and now I will take a look at the questions, because apparently I'm already alone here. Yeah, one comment about the MIC. Yeah, I will keep that in mind, and we will. I will see what can be done about it. But sure, thank you for your comments. Yes, are the short-term Hearst exponents useful to tell us how likely we are to continue under this regime? Yes, both short-term and the long-term, they are telling you that, but which is exactly the likelihood of the move continuing. It's exactly so. Hearst exponent can be translated in a very simple way. It's just a probability that the market will go to the same direction where it went today, or let's say before. So yes, high Hearst show a strong trending environment, and when you see a short-term Hearst of 76% and the stock drops like crazy on that day, or so, sadly, of course, sadly it's quote unquote, but there is a very, very high probability of 70% that the move will continue. And same with reverses. If it reverses, strong Hearst assets tend to have bigger retracements, bigger moves. Yeah, so what happens tonight in China, I don't know. I think bloodbath, but as always with markets, first I need to see it, and one day at a time. But I don't know what happens in China, and we will all know that. So yeah, the comment about treasuries, thanks for letting us know. It's very important, I believe, for people now, especially when we see bonds falling and so on. I still think that this fall in bonds is, for me to really consider that a very important event. I need to see that break below. So, of course, if I see that, I will tweet. But for now, I still think that bonds are in buy the dip mode, and when it comes to bonds, especially, of course, depending on where in the curve you are, but especially in the not too long end of the curve, you will be okay. So yeah, I forgot to close my stream. So thanks everyone for joining. Thanks Ted and Matt for their views, and like I said, extreme volatility is ahead. We will get rips, we will get breaks. Don't do very risky things. Better sit in cash and wait for clearer signals. especially monitor volatility, because in this volatility regime, it's just crazy for you to try to bottom fish or do something like that. So yeah, be safe out there. See you all in 2 weeks, and thanks for joining. Good luck.